leading off here, right?
I am, yes. Thank you very much, Senator Moulton. Appreciate the invitation to be here with all of you today. And let me get this screen share going. Is that now visible for everybody?
Yep, we got it.
Perfect. So I wanted to start off just a quick introduction of myself. My name is Jesse Proudman. I'm a lifelong entrepreneur, Washington entrepreneur. I founded my first company in Tacoma at the age of 13 and founded my previous company, Blue Box, from my dorm room at the University of Puget Sound in 2013. It was a bit of a funny story, given Blue Box was the first business license the city of Tacoma had ever issued for a dorm room. I think probably the first and last. I bootstrapped Blue Box for 9 years before ultimately raising about $22 million in venture capital. We scaled the team to about 65 people, predominantly located here in Washington. And then Blue Box was acquired by IBM in June of 2015, really with the effort to seed a broader IBM cloud footprint in Seattle as part of this initiative, where Seattle is sort of the cloud hub of the country. Following the acquisition, I became an IBM Distinguished Engineer and then proceeded to become an entrepreneur in residence, working with IBM Ventures in 2017, focused on launching an accelerator program in the blockchain space to match startups with IBM customers focused on blockchain. I'm an active angel investor here in the Seattle region, and I'm a board member and deeply involved participant with the University of Washington's Berg Center for Entrepreneurship, and have a wonderful wife and 2 kids here in Seattle Public Schools on Queen Anne. Wanted to give a quick overview on what Strix Leviathan is, our company and background, just to give some context for the rest of the presentation. So I left IBM at the end of 2017 after spending the year becoming absolutely fascinated with what I saw happening in the blockchain space. IBM had made some budgetary decisions not to pursue the accelerator, and I elected to find an opportunity in this space. And so I founded Strix Leviathan as a technology-first digital asset manager with my co-founder, Sadie Rainey, in January of 2018, with the belief that the digital asset space really lacked the infrastructure required to effectively trade these markets. It was a very immature space at the time, and we needed to build technology to help market participants. Over the last 3 years, we developed one of the most comprehensive investment software platforms in the industry. We call this software platform Octopus. And we've grown AUM, or assets under management, in our investment vehicles to over $10 million. We're actively developing a second product called Makara Digital that we plan to bring online in Q1 of 2021. That's a Wealthfront meets BlackRock for digital assets. So a sort of a robo-advisor index fund product to help market participants who are interested in this space but don't understand sort of the breadth and complexity here, gain access in a simplified way. Strix Leviathan has raised a total of $3 million in seed funding, predominantly from Washington-based investors. So we have 29 investors, or equity holders on the cap table, including 4 Washington venture funds. So I wanted to start and talk to you today about the state of regulation facing companies involved in the digital asset space. But before I go into the details there and some of our story, I want to make sure we all have a shared baseline understanding of the industry. So the blockchain industry, or the digital asset industry, was born more than a decade ago. On October 31st, 2008, an anonymous character under the pseudonym Satoshi Nakamoto released something called the Bitcoin White Paper to a mailing list of fellow cryptographers. Within this white paper, the author described a novel technological method to prove ownership of digital assets in a trustless way, a major breakthrough powered by what Satoshi coined the blockchain. Prior to Bitcoin, digital proof of ownership relied upon trusted third party. For money, this was solved by companies like Venmo or Apple Pay, where you have a central company that tells each person how much money is in their bank account. Satoshi's blockchain invention created a way to computationally prove digital ownership and a way to transfer that ownership without being reliant on intermediaries. For the first time, there was a way to enforce a notion of digital scarcity to prove ownership of digital assets. While this notion of scarcity was the true invention with the blockchain, there were a number of other compelling characteristics worth noting. The Bitcoin blockchain is permissionless. Anyone can interact with Bitcoin, view transactions, run a node, or run mining infrastructure to power the network. There are no gatekeepers or people that say who can and cannot participate. The Bitcoin blockchain is decentralized. It does not rely on a single server or governing party or company. It's powered by thousands or hundreds of thousands of participants around the globe. This also means that the protocol and the technology that powers Bitcoin can't be changed by a single person. The Bitcoin blockchain is uncensorable. Because there's no centralized arbiter, there's no way to block or reverse transactions that occur on the blockchain. And finally, the Bitcoin blockchain is global. Anyone in the world with internet connectivity can access and participate within the network. While Bitcoin was the first blockchain, innovation certainly hasn't ceased over the last decade. The industry has seen the rise of a diverse set of technologies focused on all kinds of use cases beyond Bitcoin's initial. From platform tokens that are focused on providing distributed computing platforms to the next generation of applications. So think about sort of Amazon's cloud, but run in a distributed way, to security tokens, providing a way to provide fractional tokenized ownership of assets like art or property, to governance tokens, providing holders the ability to vote on changes to operational parameters of a specific network or organization. This technology has really unlocked a world of possibility, and the sky really is the... Oh, pardon me, 1 second. All right, we're back. Can you see the screen still?
That's good, yeah.
Perfect. So over the history of this asset class, most of the interest has been fueled by retail investors because institutional investors have struggled to participate as a function of regulatory question and considerations. Notably, and this is one of the more exciting things about this asset class to me, this is one of the first times that everyday people have had access to participate in an investable asset class before the mighty institutions. Oftentimes, it's the venture capitalists that are able to invest in startups before everybody else, and this sort of changed that entire dynamic. Everything changed, though, in 2020. We have regulated futures and options products from the CME, exchange-traded products from companies like Grayscale, and qualified custodians like Fidelity have opened up this asset class to the world's largest allocators. Over the last 8 weeks, we've witnessed a daily drumbeat of major institutional players proclaiming their interest here. From Skybridge to Guggenheim to JP Morgan and PayPal, the institutions many of us said were coming in 2017 and 2018 have finally arrived. So this industry has rooted itself over the last 12 years, but it's an industry that has moved unbelievably fast, and the global regulatory footprint has naturally struggled to keep pace. I wanted to spend a few minutes highlighting the challenges that startups like ours have experienced nationally and in Washington state. So I want to start first with compliance costs. For any startup, runway, or the amount of cash we have to fund operations until we reach a point of profitability, is a paramount concern. We raise capital at the beginning of the company, and we use that to bootstrap until we become profitable. So we focus an unbelievable amount of energy on preserving that runway while making investments in people and product. I wanted to highlight our experience at Strix Leviathan because I think it tells an interesting story. Strix was founded here in 2018 in Washington state. At the same time, other funds we've subsequently become friends with were founded around the country and in other global jurisdictions, often in the Caymans or the BVIs. If we had started Strix Leviathan as a venture capital fund to make investments in a liquid private securities, opposed to a fund trading liquid digital assets, registration and foundation of the organization would have been a straightforward process. We would have spent likely $40,000 to $50,000 on legal expenses and been up and running fairly quickly without much struggle. But naturally, I chose the hard path, and we chose an emerging asset class, one with an opaque and emerging regulatory landscape. And because the rules are not yet written, we had to work with lawyers to identify what we believe the rules will be and attempt to structure a business in a way that would satisfy those rules. And sometimes those attempts proved to be incorrect, and we had to redo significant amounts of work. So over the last 3 years, we spent $500,000 just in legal and compliance costs to set up and operate our business the right way. And this is for a company that's raised in total $3 million in seed capital. Circling back to the other funds that exist around the globe, we've been disappointed to discover it has cost us 3 to 4 times more in legal and compliance costs to obtain similar outcomes as those vehicles. These costs have had an unfortunate effect of impacting how we can invest in our team and headcount in the state. Over the last 3 years, we've been forced to reduce our headcount and delay hiring roles while we pushed forwards towards profitability, first making aggressive investments in our team that would help accelerate that path to profitability. And we're not alone in this. One of our advisors, Bill Shahara, is the founder of digital asset exchange Bittrex, located in Bellevue, Washington. Bittrex was one of the first digital asset exchanges in the United States and one of the largest during the 2017 market cycle. Compliance has been both a consistent focus and a cost center for Bittrex. Today, Bittrex is paying more than $1 million a month on average on legal and compliance cost overhead, working with regulators on a state, federal, and international level. That translates to another 48 heads that Bittrex would be able to hire, but otherwise can't. The reality here is that the corporate lawyers are the biggest benefactor of this regulatory environment. They're profiting at the expense of the hardworking entrepreneurs and at the expense of additional jobs we could be adding to the economy. A second challenge for companies operating in this space is centered around retroactive penalties that can be applied even for companies operating in good faith. Because the space is moving faster than the pace of regulation, companies must make their best effort to comply with unwritten rules. As I just noted, the cost of attempted compliance is incredibly high, but because we all want to do the right thing, we pay it. The challenge is that even when we try to do the right thing, the way the laws are structured, if it turns out the approach we took wasn't the proper approach post facto, we still could be penalized. We experienced this exact issue with Strix in 2019. This creates a major disincentive to even try, and certainly creates a disincentive for companies to move to Washington State. We've seen a number of promising companies actually leave the state, moving all of their employees elsewhere because they're concerned about the nebulous unknown that this creates. At Strix, relocation is something we actively considered and researched this year. We were fortunate to have made significant progress in our dialogue with the DFI on a path to keep us located in Washington, a fact our families are grateful for. SEC Commissioner Hester Pierce laid out the issue succinctly by saying, the analysis of whether a token is offered or sold as a security is not static and does not strictly adhere to the digital asset. The technology and facts in this space evolve rapidly, and regulation naturally has a hard time keeping pace. To combat this reality, we believe there's an opportunity to create a safe harbor provision to provide immunity against fines and penalties for companies who have been operating in good faith. This would create an incentive for companies trying to do the right thing. And safe harbor doesn't have to mean providing immunity to bad actors. It can be very clear when companies are trying to operate within the bounds of the law versus when companies are trying to do everything in their power to skirt the law. We believe a partnership between the DFI and the state legislatures focused on regulatory safe harbor would bring immediate benefit to the state in terms of job creation and the potential to attract new businesses to Washington. The last major challenge I want to touch on is focused on the notion of a clear taxonomy for what is and what is not regulated in Washington. The DFI has regulatory jurisdiction over securities and companies that manage securities on behalf of others. But determining what assets in this industry are classified as securities is a near impossible task for startups. When we launched our business, the legal advice we were given was to walk through every asset we wanted to trade and attempt to apply the Howey test to each. I think I saw the slides that the DFI president, and they'll talk to you more about the Howey test in a moment. This is exactly what we did. And after combing through hundreds of assets, and there's about 6,500 assets in total in this space, and spending weeks of effort at the beginning of our business, we came up with a list of assets we believed we would not be able to touch because they were considered securities. Thus, we traded things that we thought we were legally able to trade, and we put aside the things that we thought we would be not permitted to trade. The challenge is that our interpretations and the interpretations of the DFI were not aligned. The result was friction between our two entities and another pile of legal fees we had to pay to sort out the differences. The issue of taxonomy is a challenge, given there are federal regulators who are also attempting to solve for these issues. In light of this reality, it is natural to understand the state not wanting to preempt federal definitions, so the natural tendency is to wait to create this taxonomy. But this delay creates the exact scenario we just discussed, where companies attempting to do the right thing can be penalized. Beyond taxonomy, another issue that exists for Washington businesses is opaque guidance on how to register their digital asset business to be compliant. As an asset manager, we are working with the DFI to be the first registered investment manager in the state, an RIA, trading these assets, and we feel we're on a good path to complete that early next year. But as the first, much of the onus on defining that path to registration has fallen on us, and we've borne the cost of sort of blazing that trail. For other companies, they may be working to determine if they need money transmission licenses, MTLs, or other registrations in the state to operate. There is not a clearly defined flowchart today that says if your business does X, you must register as Y. So again, it puts the operational onus or burden on the startup and prevents sort of new market participants from having an opportunity to participate in these markets. A taxonomy of assets or a mechanism which a startup could use to generate their own taxonomy would go a long way to solving these issues. Couple that with clear guidance on how organizations can operate in a compliant fashion from a registration perspective, and we would eliminate an incredible burden on these entrepreneurs. To close out this section, I wanted to highlight a few of the common criticisms of this industry, as these are often used as reasons why regulators should not provide clarity. Many people assert that Bitcoin provides a path for money laundering. And the reality is, that not many people appreciate that the Bitcoin blockchain, the ledger that powers Bitcoin, is completely public and completely transparent. Bitcoin is not an anonymous network. All transactions are visible and traceable, and an entire industry is cropped up focused on data analytics for anti-money laundering purposes. Chain Analysis is the leading company in this space and has contracts with many federal three-letter agencies doing this exact work. Another common criticism is that much of this industry is full of fraud and scam. While 2017 did indeed see its fair share of lofty ideas with limited execution, 2018 and 2019 price action evicted the majority of these market participants. This was the free markets at work, and digital assets in 2020 are a completely different ballgame. Applications built on these technologies work, user experiences are complete and leaps and bounds better than they were in 2017. And while no industry can stamp out fraud in its entirety, this industry has done an admirable job self-policing and focusing on the builders and innovators instead of the charlatans. The last common concern I wanted to touch on is the notion of hacks and theft. Since Bitcoin and much of this asset class are bearer instruments, whoever holds the private keys, the encryption keys behind these individual blockchains, controls the coins. This can result in easy loss of capital unless proper security measures are taken. And in the early years of this industry, we saw example after example of lackadaisical security practices from exchanges, resulting in loss of user funds. But fast forward a decade, and massive effort has been invested in the security and protection of investor assets. Qualified custodians have sprung up whose sole job is asset security, and exchanges operate with some of the most advanced security practices and security teams in the world. While it's easy to look at a new emerging industry and point to all that is wrong, it's important to consider the bigger picture. Why does this matter to Washington State? And how can the state benefit from this emerging asset class? The reality is that this industry is not going away. As Ben Bernanke said, virtual currencies may hold long-term promise, particularly if the innovations promote a faster, more secure, and more efficient payment system. This technology creates all sorts of opportunities for new forms of disintermediation to support new types of business. The functions of the traditional intermediaries, such as confirmations of funds and transaction audits, are not removed from the middlemen, but are inherent in the technologies themselves. This reduces fees for all businesses transacting on the networks. I was excited to participate in this industry because it's the first industry that reminded me of the internet circa 1997. The Bitcoin blockchain works, the networks here work, and a whole new world of applications are being built on top, much like the internet worked in 97 and the applications that we know today were still being determined. Blockchain is to the future of finance as the internet was to the future of commerce. Paul Krugman, winner of Nobel Prize in Economics, wrote in 98, "The growth of the internet will slow drastically as the flaw in Metcalfe's law, which states that the number of potential connections in a network is proportional to the square of the number of participants, becomes apparent. Most people have nothing to say to each other. By 2005 or so, it will become clear that the internet's impact on the economy has been no greater than the fax machine." In the late 90s, the world didn't fully comprehend the impact the internet would have on anything and everything we do in life. And we're in the same situation now with blockchain. I also wanted to highlight that companies like IBM recognize the opportunity this industry creates. In my last year at IBM, as entrepreneur in residence, I saw firsthand the importance of blockchain as part of IBM's strategic initiatives. IBM built a massive organization focused specifically on this industry because they see the potential it can provide. A single transaction in this global network can have half a dozen or more potential regulatory jurisdictions. Depending on the coins traded, there are even more. For example, Strix Leviathan, we are a Delaware-registered company domiciled in Washington. We trade with other companies registered in Singapore but domiciled in Hong Kong, and we work with custodians registered in South Dakota but domiciled in California. This is a complex regulatory web. Given time constraints, I won't dive into further nuances here, but encourage further research on MyCar and the FAFT travel rule. Further, it's worth noting that other states have taken various initiatives to establish themselves in this industry. Specifically, I want to call out Wyoming, who has enacted a number of blockchain-specific laws and has seen a significant increase in companies moving to the state as a function of the regulatory clarity they're providing. For the past 2 years, we've been working with the DFI to become the first RIA in the state focused solely on digital assets. Their willingness to engage in open dialogue has been extremely important to our commitment to stay in the state. I also appreciate that what we're asking for is not a simple task. I understand this is a journey, and I'm delighted to have the opportunity to be here with you today and to continue to engage to work towards solutions for this industry. The United States risks being left behind. The US led the internet revolution because we fostered the technological innovation that propagated around the world. For blockchain, the US started off strong, but the regulatory challenges we've discussed today have created a situation where foreign jurisdictions become very attractive. China has been the biggest beneficiary of this trend. Both Bill Shahar from Bittrex and I believe permitting China to dominate this industry would have catastrophic consequences to both national security and to our technological dominance worldwide. Investors are ready for the space and they're interested, but they're scared. According to Fidelity Digital Asset Report, the majority of investors have a positive perception of the space and believe these assets belong in an investor's portfolio, but 40% of investors have concerns about the regulatory environment. We have an opportunity to fix this. COVID has obviously changed everything for all of us this year. It's widely accepted that the work environment tomorrow will look nothing like the work environment we knew from last year. Companies are fundamentally making a shift to remote work, empowering employees to choose where they want to live. Technologies like SpaceX's Starlink will open up remote work into geographies previously inaccessible. Washington is uniquely positioned to benefit from this. We have a friendly tax jurisdiction in a beautiful, desirable state. We are rich in both entrepreneurs and engineering talent from some of the best companies in the world, and we have some of the best research universities in the nation. Blockchain companies are searching for jurisdictions exactly like what we can provide. Let's make them want to move here. In closing, thank you for your time today. I'm incredibly motivated to find a way to establish the state as a leader in this industry nationally and internationally, and I want to volunteer my time to the committee and to the state to act as a resource as we continue to work towards figuring out how to achieve these objectives.
Thanks, Jesse. So Wyoming, you mentioned as the example, did they actually pass laws through the legislature, or was it something that was done through their equivalent of DFI in a regulatory way? Or how did Wyoming, what did they do exactly? Do you know?
Yeah, my understanding is that they've passed around 9 different laws to clarify the regulatory status of these assets, and specifically laws around some of the banking rules. So some of the issue nationally is that there is not regulatory clarity on how these assets can be banked. And particularly this impacts us under this notion of a qualified custodian and who can be a qualified custodian. So Wyoming has tried to provide clarity on who can register as a bank and how that bank can act as a qualified custodian for the asset class. And that's caused one startup bank and an existing operating company to relocate to Wyoming to obtain banking charters.
Okay.